Well, at the beginning of the year, we started out with anticipation of 6 rate cuts, which turned into only 3, which turned into only 1, and then there was none. Well, now there's talk of rate cuts again. Let's find out what's going to happen. Joining us from Bianco Research is Jim Bianco. Jim, let's begin with how the narrative is changing. And I guess my first question is, what happened? Why now?
Well, I think the narrative changed in the day we're recording is the day that the consumer price index for June came out. And it surprised again to the downside with actually a negative 0.1 number, followed by the previous month in May, it's 0. So you've had 2 months in a row where you've had at least 0 on the inflation numbers. And that has brought the year-over-year inflation rate down to 3%. Equaling its recent low of June of last year, exactly 1 year ago, when it was also at 3%. And that's brought back the idea that there might be a rate cut as soon as September. And the market is pricing that in at around 85% or so. But if you've been following these machinations, that can last as long as the next strong economic data, and then we'll see where it goes. But I think it's really about this idea that the inflation rate is finally on its glide path to 2%. Mind you, we haven't even gotten below 3 in any major way. And I'm talking about the CPI statistics now. But yet we're going to go to 2, and that's going to open the door for the Fed to at least entertain a rate cut. And let me throw out one other idea too about this. Earlier in the week that we're recording, Chairman Powell spoke in his congressional testimony before the House and the Senate. One of the topics he did broach was this idea about the neutral funds rate. What is the funds rate that the Fed would have to get to that neither stimulates nor restrains the economy? The Fed thinks that's 2.75%. But if you look at most market measures, the market thinks it's about 4%. Why is there such an urgency to get started with these rate cuts? Because those that are at the Fed and those that think like the Fed think that they have to get the funds rate down to 2.75%, otherwise known as 10 25 basis point rate cuts. And so they think we've got to get going here. We got a lot of work to do. We got 10 of these to go to get it back to neutral. But those that side like me, more about the market, and it's closer to 4, the neutral funds rate, then they've only got 4 or 5 that they have to go to before they get back to neutral. And if they cut in September and then they start talking about one more cut before the end of the year, they're already halfway back to this neutral rate based on where the market thinks it is before they even get started. In other words, that's one of the arguments I've been using why they shouldn't be in any real hurry to cut rates. And they should wait to see if there's any more data that suggests that the inflation rate is continuing to head lower, or was this the bottom in the monthly numbers? And or if the economy is really slowing down enough to warrant it. Because I think that the neutral funds rate is around 4. So they only have 4 or 5 cuts, not 10 to go, so they can afford to wait.
So if we look at this, I think it was Citigroup that just came out, they're predicting 8. And we all know, Jim, like we began this year with 6 rate cuts, and then all of a sudden 2 or 3 months of inflation data, and we went from 6 to none. So this seems to me, it's very fluid. It could change with the next economic report.
It can, and it probably will change with the next economic report. But again, it gets down to this whole idea of where are we with the economy? Because also remember at the beginning of the year, there was all that talk about a soft landing, whether or not there'd be a hard landing, that the economy was going to slow too much. It was going to cause a big rise in the unemployment rate. Now, to be fair, the economy has slowed somewhat this year. The unemployment rate has gone up, but as far as the slowing on the economy, it hasn't been that dramatic. The rise in the unemployment rate to 4.1% is largely now being attributed to the influx of migrants over the southwest border, Because remember that the way that the unemployment rate works is they survey households. Is anybody in your household been looking for a job in the last 30 days and unemployed? And even if that household has undocumented migrants in it, the answer could still be yes, and that it swells up the number of unemployed people, which raises the unemployment rate. And so that might be the reason why we're seeing this uptick in the unemployment rate, not so much that the number of jobs are disappearing or people are being laid off at a higher rate. So there's been some discussion about that. But the bottom line is, back when we were talking about 6 rate cuts, we were also talking about a dramatically slowing economy. Well, we've got the misses or the lower than expected inflation numbers that got everybody talking about rate cuts. We don't really have that weakening economic data to really support it. And just to give you one anecdote that kind of got lost on the day we were recording, what also came out today was initial unemployment claims. They dropped to 222,000 from 235,000. That was its biggest drop in 10 months. And it's back down to one of its lower levels right now. So that measure is at least not showing much weakness in the labor market.
So if we look at the economic numbers, as you mentioned, they could be distorted with this, with a lot of immigrants that have come into the country. Let's talk about also the amount of money that the government's spending. I can't help but believe, I think, what was it? The CBO came out and they said the deficit this year will be 1.9 trillion, which is roughly about 400 billion above where they started out in February. That's a lot of money you're pushing into the economy.
Oh, it's an extraordinary amount of money. So we all know that gross domestic product, GDP, is the production of the United States economy, and it runs at around $30 trillion nominally. 22%, somewhere between 21 and 22% of the US economy is the federal government. There's only been 2 times in American history it's been higher than the current level. The COVID response, but that was a one-off kind of special situation, in World War II, which was also kind of a one-off special situation. Typically, what the government does is they spend a lot of money to stimulate the economy when it's going into a recession. And then they usually back off of that spending during the recovery. Well, we spent a lot of money going into the COVID recession, and we've backed off since the COVID peak in the amount of government spending, but we're still spending money. The federal government is spending at a rate that is higher than it does when it's panicking in all other previous recessions and World War II. That alone should tell you there's going to be no slowdown in the economy. The government, by its sheer might and will continue to spend. Now, what does spending mean? Production. It means it's employing services, it's buying goods, it's transferring things to people. That can also put pressure on prices, which is, demand for goods and services, which is a fancy way of saying keep the inflation rate somewhat elevated. And that's why I'll even point out again, a year ago, the inflation rate was 3. Today, the inflation rate is 3. That's headline CPI. And it's vacillated between 3.5 for the last year. I've long argued that I thought that the inflation rate would bottom somewhere in the 3 to 4% range. Well, for the last year, that's exactly what it's been doing. It's at the bottom end of that range right now. And we shall see in the subsequent months, does it continue to sink below that, or does it hold this 3% level? And then we have to start thinking about that. We've got higher inflation. And one of the big impetuses for all of this spending, because you hear people talk about the consumer's tapped out, he can't spend as much money, that people are shifting their preferences or that. But you've also got this massive government spending. And how are they financing that government spending? That $1.9 trillion deficit that you talked about, that the government takes in taxes, spends all those taxes, and then borrows an additional 1.9 trillion on top of that in order to finance this $6 trillion of spending a year. 4 of it is financed by taxes. Basically, 2 of it is financed by debt. And that's how they continue to push that along And if they do, it's going to be very hard to see the economy slow and inflation come down to any great degree.
Now, there's another month they're going to have their quarterly funding estimate. And they're talking about, Jim, that, or at least some Fed governors are talking about that they will be shifting that funding to the short term end of the market rather than the long term. Let's talk about that and what that might mean.
Well, that's going to be difficult for them to do because there is a thing called the Treasury Borrowing Auction Committee, and it's a group of people that meet at the Treasury, Wall Street bankers and the like, that advise the Treasury on what is the best way to finance the trillions of dollars of government debt. They have recommended to them that no more than 20% of all of the debt issuance in the United States be short-term T-bills. It's currently running at around 22, 23%. So they're running above their recommended target. So if there is going to be a further push for them to increase that short-term debt even more, they're going to be well above their targets. And they're worried that when they start to offer that much volume of Treasury bills, remember that Treasury bills, without getting too into the weeds with the plumbing of the financial system, Treasury bills are considered a cash substitute. So when Bank of America has to send JP Morgan billions of dollars, it isn't a line of Brinks trucks with $100 bills in the back that they send them. They wire them billions of dollars worth of Treasury bills because it's used as a cash substitute. Well, that is a very delicate balance, that financial plumbing of the system. If you introduce too much debt by issuing even more short-term securities, you risk upsetting that. And that's what the Treasury Borrowing Auction Committee is worried about. And they actually want them to shift the debt more long-term, issue more 2 years, 5 years, 10 years, 30-year securities. That's where they want them to shift it, is to more to the long term. But the Treasury is part of the executive branch. Treasury Secretary works for the president. That's their boss. President does not want interest rates to go up in an election year. Issue more bills. We want 10 years to go down. We want mortgage rates to go down. We want to get reelected. So that's the rub that the Treasury Auction Committee is going to have to face when they meet at the end of July, is whether or not they are going to continue to run this Treasury bill issuance above 20% of all Treasury debt security. They're already above it now. Or are they going to back it down to 20%, which is a fancy way of saying they're going to issue more 10-year notes, they're going to issue more 30-year notes, issue less bills, but then they risk that additional supply could push up those long-term interest rates in the months ahead of an election. So they're going to have a tricky decision ahead of themselves. I suspect that there's going to be a lot of pressure on them to lengthen the maturities, to go out there and push down that 20%. They don't want to mess with the financial plumbing where these Treasury bills are used as cash. I'll say one thing about the financial plumbing. I've talked to people that dedicate their careers to trying to understand the financial plumbing of the system. And they will tell you in all honesty, it is such a complicated system that nobody fully understands it. So therefore, don't be introducing unknown variables to such a system like, let's just issue more Treasury bills. Let's go well above 20%. What could be the harm? We don't know maybe nothing, or maybe something that we don't know. And their argument is, let's just not go there in the first place. And that's why I hope that kind of thinking takes over and that they don't try and go there in the first place.
I want to move back to speaking about the election coming up. I think before we went on the air, we were talking about both candidates, whether if it is Biden, if he remains the candidate, and it's Trump. You have two knowns. You know what Trump's policies are. He was president. You know what Biden's policies are. He's been president. So it doesn't appear to me that there's a lot of uncertainty that the guys on Wall Street could say, gosh, we don't know what's going to happen. Wall Street knows both these guys. What's your take on the election? I just, other than if something we can't see happens, I don't know if it's going to have much of an effect at all.
I completely agree with you. Wall Street likes to play this parlor game every 4 years. Well, if the Republican gets elected, you want to buy defense stocks. And if the Democrat gets elected, you want to, buy technology stocks or some version of that, or, sell healthcare stocks. And I've come to the conclusion after looking at that every 4 years, that never works. It's always way more complicated than everybody thinks it is. So, the simple answer, well, if Trump gets elected, this is the investment thesis, or if Biden gets reelected, this is the election thesis. That never works. Now, what has been interesting through all of the histrionics since the debate about whether or not Biden's going to get removed is if you look at the financial markets in isolation, you'd be hard-pressed to find that that's been bothering them. It's really not. Now, why isn't it bothering them? Because I think on Wall Street, the answer, unfortunately, is either one is going to have effectively the same policy. I'll start with the current president. If Biden was to get reelected, or if a Democrat in his place was to win election, then huge government spending and huge deficits will continue to be the order of the day, like it has been, like we talked about a second ago. But if Trump gets elected, then the argument is what you'll probably see is tax cuts. But you might see what you saw with Reagan in the early 80s. When Reagan came in the early 80s, he cut taxes. He was supposed to cut spending. He supposedly had a deal with the then Speaker of the House, Tip O'Neill, to cut spending. And that never, ever really materialized. And we ran huge deficits after the tax cuts. So the fear is if Trump comes in, he'll cut taxes, but we'll still have huge deficits. So Wall Street's looking at it just going, Biden, huge deficits. Trump, huge deficits. We're going to get them either through more spending or through tax cuts. They're kind of the same thing. And that's why I think you see that if you go back to June 27th with the debate and how that so drastically altered the short-term trajectory of this race, because we don't even know, as we're recording, who's going to be the Democrat nominee. Again, if you look at the stock market, if you look at the bond yields, what was the trend before June 27th and what was the trend after? The answer is they're kind of the same. What was the trend in the dollar before and after? The same. Commodities, the same. Gold, the same. So the takeaway there is all the histrionics around the debate and whether or not Biden gets removed and whether it bolsters Trump's chances or doesn't, it doesn't bother Wall Street because I don't think Wall Street thinks it matters. Now, to be clear, the election of the president of the United States matters a lot for a lot of things. Social policy, foreign affairs, the two wars between the Middle East and in the Ukraine. It matters a great deal for all of those. But it doesn't look like it's going to bend the trajectories of, say, interest rates or the dollar or the stock market as we understand it right now. And maybe as we get some clarity on this, it might in the future. But right now, Wall Street's kind of treating this like it's important, but it's not important for Wall Street.
I want to talk about the spending that we've been discussing and also the deficits. I mean, as you mentioned, we're spending as if we were coming out of a financial crisis or a recession. I think we're at 35 trillion now. And there's a question, how long can this continue? But then I think of, look at Japan and look at how much they're spending. Look what their deficits are. So in your mind, when does this really wake up let's say the bond vigilantes? They wake up one day and say, that's enough.
I think you got it right. You know, the moniker that they've put on Wall Street about it is they call it the Liz Truss moment. Liz Truss was the UK prime minister 2 years ago. And she came in and she was a conservative, a Tory, and she put out their budget, which cut taxes, increased spending, and dramatically increased their deficit. Their Congress or Parliament was going to go along with it just fine. And then their bond market, which is the UK gilt market, exploded. Prices fell by the most on a daily basis in September of 2022 and on a weekly basis than any time. And the Bank of England has 300 years of data. So in 300 years, the worst day and the worst week was 2 years ago around that mini budget. Interest rates went up over 100 basis points in a couple of days. It created what was called the liability-driven investing crisis. For those of you, when interest rates, like I was talking about earlier, the plumbing of the financial system is so complicated and so opaque that when you introduce an unknown variable to it, you might cause problems. Well, the same thing you could say about the bond market in general, the UK bond market, the US bond market. If you take interest rates up 100 basis points in 3 or 4 days, you're going to break something. And that's what happened in the UK. They broke something, that budget was scuttled, and that was the Liz Truss moment. So yes, I agree. We're going to have some version of that to get the bond market vigilantes back. In other words, there isn't a Hamilton or Jefferson on the ballot that is going to, get elected and then next year sit down and go, we can't keep spending like this. We have to stop spending. They're going to keep spending until the bond market blows up, causes a crisis, and forces them to change. Now, when's that going to happen? And the answer is nobody knows when that's going to happen. It could be later this year. It could be in 10 years. It could be anywhere in between. But this is the concern that we all have, is that we are looking at one way out of this. And that is that we're going to have the bond market vigilantes exercise some discipline on Wall Street. And that's, again, a euphemism for all us investors have to lose a ton of money, and we have to then create a crisis, and then we have to then scream at Washington, and Washington's going to say, I'm very sorry, we're going to change so that you can get some gains back in your portfolios. And then we're going to say, well, why did we have to go through this in the first place? But unfortunately, it seems like we're going to have to. But that is where I think we're going to go. Now, I don't know when that's going to happen. Some people have argued maybe it's going to be foreign investors pulling out of the U.S. That's a good argument, but the problem is, that's like with the dollar losing its reserve currency status. Sure, the dollar's ripe to lose its reserve currency status as soon as an alternative shows up. There isn't an alternative. And so it's not the euro, it's not the yuan, it's not the renminbi, it's not Bitcoin. Maybe crypto could be an alternative in 20 years, not now. It's not ready now, and it's not going to be ready anytime in the next many years to be that alternative. So right now, the dollar is going to maintain its reserve currency status. And so I don't see foreign investors pulling out. So I think that, unfortunately, this is going to keep going and going until we get to some kind of a Liz Truss moment, and no one knows when that's going to be. And then it's going to be painful. And then hopefully coming out of the other side of that will be some sanity with the way that the government is running its finances and its budgets.
Final question, if I may. I want to talk about the S&P and its dominance by a handful of stocks. In fact, one forecaster the other day said, if you want to know where the S&P is going, look at these 7 or 8 stocks and they'll tell you all you need to know. A lot of people, they go into index funds. I'm diversified. I've got 500 stocks, but the index is dominated by a handful, which is great when the index is going up and money's pouring in, but not so great like in 2022 when money comes out.
That's exactly correct. The whole idea about buying broad-based portfolio of stocks, otherwise the S&P 500 index would be one example of that, is to get that diversification. But you're not getting that diversification. And let me give you one statistic. Through July 10th, which is the day before we're recording, the S&P was up 18% for the year. That's a pretty good year. If you take out the Magnificent Seven stocks, the Teslas and the Microsofts and the Amazons and the Googles and the Metas and the Apples and the Nvidias of the world, then it's only up the other 493 stocks. If you were to create an S&P 493 index, it's only up 8% for the year, as opposed to 18%. So those 7 stocks are over half of the returns of the market. Now, a lot of people have been doing these measures and showing you could go back 50, 60, 70 years, and you're not going to find a period that has been that concentrated in a handful of stocks pushing up the entire index. What does that mean? You're not as diversified as you think you are. If you own a broad-based index of stocks, you are at the whims of Apple and Nvidia and Microsoft and Meta and Alphabet, Google, and the rest of them, and whether or not they continue to lead higher on the AI revolution or whether or not it's over its skis and they decide to correct. Okay, well, what if I decide to go into other stocks? Well, then the problem is, as of July 10th, the mid-cap stock index, the S&P 400, which is the next 500 stocks after the S&P 500, is up 4%. And the Russell 2000, as of July 10th, was up 1.3%. And cash was up 2.9. So all of a sudden, if you take those 7 stocks out, you look at the 493, it's up 7%. If you look at the mid-cap stocks after that, they're up 4. And if you look at the small-cap stocks, they're up 2. That's year-to-date returns. And all of a sudden, a 3% money market fund looks very competitive with everything but those 7 stocks. This is, I can't emphasize this enough. This is unprecedented. We've not had a situation like this in the market. Yes, we've had situations where a sector in the market takes off and goes up multifold, but usually those sectors are very small and their impact on the overall index is not very great. But in this case, it's the largest stocks got even larger and they've swelled up the returns of the entire index. And this has been the biggest problem. A friend of mine who's looks at this stuff likes to say that if you look at the correlations in the market or you look at the dispersions, the dispersion is from the best performing sector to the worst performing sector, they're very wide. And he says, the dispersions are very wide and the correlations are very low, meaning this is a great stock picker's market. And then he turns to me and says, except you had to have picked 7 stocks or you have no chance of outperforming. And now, and so this is a very, very difficult situation for everybody to basically be stuck with, is that we're being dominated by these big stocks. You want to be there because they're the ones that are performing. But when that cycle turns, it could become the opposite. And the opposite could be, I could envision a period where all of a sudden the indexes are just being dragged down and down and down because these 7 stocks are going through a terrible correction. Whereas if you just randomly picked anything else, you would have outperformed. Small cap stocks are doing better. Mid cap stocks are doing better. Pick 3 letters out of the alphabet. That's probably doing better. Because right now it's the opposite. If you don't have those 7 stocks, go ahead and pick 3 letters out of the alphabet. You're underperforming all of that stuff. So you could wind up seeing the opposite of that happening on the next turn. And like I said, I'm not going to sit here and tell you I have an answer for it. No one has an answer for it because the level of concentration in this market is totally unprecedented.
The final question as we end, if you were looking forward, as we've been discussing in this interview, we talked about there's a little bit of division over what the natural rate for interest rates for the Fed would be. So some see it much lower, others see it much higher. You're in that camp. Jim, what would you be looking for, I would say in the next month or two, for clues as to give you where we're going to be heading?
I think the economic data, and first of all, the economic data will definitely be the big clue. And starting with the day after we're recording, the big banks are going to be issuing their second quarter earnings headed by JP Morgan. That is the start of the second quarter earnings season, which should run the bulk of July into mid-August. That's an important economic statistic, the composition and the totality of second quarter earnings by all of the companies and how that does. in addition to the payroll report, in addition to the unemployment rate, in addition to retail sales, durable goods, factory orders, and the like. What is the state of the economy? Is it slowing down? If it is, then that that neutral rate of interest rate, maybe the marketplace and I'm overstating it and it's much lower. If it isn't, even if the inflation rate is coming down, maybe we are in an era of higher interest rates. That the Fed, even though the Fed's got the funds rate at 5.25 to 5.5, they only have to cut a couple of times to get back to neutral, not 10 times, as I mentioned earlier. The other thing, of course, is going to be inflation. And really, I'll point out with the inflation report, if you go back to January and February were huge numbers, 0.5, 0.4. Those are big inflation. In other words, 0.5 up. The inflation rate or prices for the month of January were up 0.5% just in 1 month. Well, that's 6% annualized. If, 0.4 in February, that's 4.8% annualized. That means that January and February were running at like a 5% inflation rate. Well, then you get to, May and June, and they were 0 and negative 0.1. Now that 5% annualized inflation rate from 5 months ago is down to 0 now. Is this the cyclical bottom in inflation and that it turns back up into the fall, or is it continue to stay very low from here? I tend to think it's probably more cyclical than anything else, that what we're seeing with the inflation rate is kind of a trough, and it will pick up and give you 0.2s or 0.3s, 0.2 or 0.3 gains for the months is what that is, and that inflation rate will stay in the year-over-year basis in the 3% range. If so, then if the Fed wants to cut rates, it might only be a couple of rate cuts, or maybe none at all if the inflation rate doesn't continue to moderate. So those are the types of data points that, I'm going to be looking at. What has been a surprise is that 0 and negative 0.1 on the inflation rate back to back. By the way, the last time we had at least 0 and negative back to back was 2020, but then that was the pandemic crisis that caused that to happen. It did take a lot of people, me included, by surprise. Didn't think that these numbers would be this weak. Nobody on Wall Street had a negative number for the inflation rate for June, and it did come in negative. And we'll have to see. That'll be the next question. Is this a cyclical bottom, or is this a signpost that we're going to continue to stay weak? I tend to think cyclical bottom, but I want to let the data tell me where it wants to go in the next few months.
All right. Well, listen, Jim, as we close, why don't you tell our listeners how they can follow your work, and also tell them about the index that you've come up with in the ETF that follows it.
Yeah. So our original business is still the research business. It's biancoresearch.com. We publish research for institutional investors. I'm very active on social media at Bianco Research on Twitter or X, on YouTube, put out a lot of videos on YouTube, and under my name, Jim Bianco, on LinkedIn. We have recently in the last year gotten into a new business. We have an ETF. It is a fixed income, long-only fixed income index. And the way that we operate it, it's very similar to the way that the S&P 500 index operates. We manage an index called the Bianco Research Fixed Income Total Return Index. We discretionarily decide, do we want to be long or short duration? Do we want to be long or short corporate credit? Do we want to be long or short mortgages? And the like. It has its own website, Bianco Advisors, tells you all about our index. There's an ETF that Wisdom Tree put out under Whiskey Tango Bianco Nancy, WTBN, that tracks our index, kind of like SPY tracks the S&P 500. And so that's been operational now for about 8 months. We've been very happy with the performance. We're one of the better performing indexes in the ETF in our sector. We're very happy for that, at least get started that way. And we hope to continue to do it that way. So biancoadvisors.com about the index, WTBN about the ETF.
All right. Well, listen, Jim, it's always a pleasure having you on the program. And sure, you're going to be looking forward to some excitement in your neck of the woods over the next month or two. So stay safe.
You're talking about the Democrat convention in Chicago where I am? Yes, I am. It'll be very exciting.
Okay. Take care, my friend.